Dixon. I'm the CEO and co-founder of Crowdfunding. Decided to cover the disruptive finance space online with a digital news site that includes crowdfunding, peer-to-peer marketplace lending, and fintech. And first of all, I would like to thank Hans Singh and her crew for inviting me here to participate in this wonderful event today. This is my second year to be back at Crowdfunding Asia, and I'm very excited to be here. So thank you very much for attending this event and for all of you that are here. So today we're going to talk about a topic that I enjoy quite a bit. Before we get started, I'm going to ask each panelist to introduce themselves. We're going to start with me, and then if you just say a few words about who you are, what you're doing, please.
Hi, it's Rose. My name is Iggy. Currently, I'm a banker as an independent commissioner in the Bank Muamalat, the first Islamic bank in the country. Besides that, I'm also an initiator for peer-to-peer lending in Indonesia. So I have two positions to fit in the ground.
Hi, my name is Mark. I'm the chairman of the Business Angel Network in Singapore and the co-chairman of ACE. I was an academic before, but now I've moved over to the corporate side. I'm a student entrepreneurship.
Hello, my name is Sam Wright. I'm representing Beehive for Asia. Beehive is a peer-to-peer lender in the business segment for SMEs.
Hi, my name is Lawrence Young. I'm the CEO and co-founder of MulaSense. MulaSense is Singapore's first legally compliant peer-to-business lending platform. So we help Singapore SMEs expand their sources of short-term loan capital by connecting them to the crowd.
Eddie Chow, entrepreneurs and investor. Involvement in the crowdfunding it is because the steering committee of the Info Community Master Plan 2025 for Singapore government. So we just published a few months ago. There's a lot of work, and part of it that you talk about crowdfunding, it is still evolving.
Excellent, thank you very much. So the topic we're talking about today is the future of banks and banking. And there's been a lot of discussion as to whether traditional banks and how they operate today, whether they will survive or not. Now, first of all, I don't hate banks. I'm not a hater for the banking industry. We write about it quite a bit. It's a lot of fun to do, but I'm not a bank hater, so just know that up front. But online finance is clearly on the rise. All forms and aspects of finance are being disrupted by the internet. This whole shift of internet finance has been exacerbated by the financial crisis. Of course, the financial crisis came along, and the first thing that regulators and politicians want to do is they want to pile on more regulations. What does this do to banks? It increases the cost of compliance. Banks have to spend a huge amount of time on compliance these days. There's a cost to that. There's also been the fallout, the reputational fallout. If you talk to a lot of younger people today, millennials, they pretty much hate banks. They think they suck. They hope that they don't have to deal with one in a few years. They'd rather go to the dentist than drive to the bank. It's not something they want to do. I actually have some survey results that say that 33% of millennials believe that they won't need a bank in 5 years, and most of them don't see any difference in dealing with one bank or another. I received a report from Credit Suisse last week, a bank that was critical of the banking industry, and they said that banks are delivering less service and value. So there's a disconnect there. It's also creating an opportunity for creative entrepreneurs and innovative types like the two gentlemen, well, sorry, It's in the platform, it's in the appear on the panel to create online finance to disrupt these things. So the question is, are banks dinosaurs? Are banks dinosaurs? It is fintech and P2P lending, that comet that is just coming blasting down to explode up, and the dinosaurs are going to look up and be gone. Is it done? Should you guys just like shut down, close up the doors, and just call it a day? Iggy, are banks, is it done for banks?
It's very provocative question. And I know that some will say yes, some will say no, so I can say maybe yes, maybe no. I will say no, let's say as long as I'm still a banker also, and say yes because I also start the peer-to-peer lending initiative in Indonesia. So I want to quote you one statement from Eric Smith in 2011 for Indonesia. In Indonesia, you have 180 million cell phones, but did you know that you only have 18% internet penetration? You're going to have your internet exposure. Now, do you know the highest penetration rate in Indonesia? It's a cell phone penetration rate. Indonesia has around 160% cell phone penetration, meaning that some of Indonesians own 2 cell phones. They carry every day, like you also have 2 cell phones. Sometimes I have 3. They put one specialist only in the office, sometimes. So the average is 160. The second highest penetration rate in Indonesia is cigarette.
So there's a correlation between smoking and talking on the phone?
Yes, there will. I will explain later. So the highest is cell phone. The second is cigarette. And do you know the financial penetration? It's only less than 40%. So that's why the government still promote the program so-called financial inclusion. So now we can say that cigarette inclusion still higher than financial inclusion. And then they ask how the cigarette nearly almost 70% for the cigarette. How the cigarette can reach higher than financial. The key is the distribution. And then based on the calculation, the bankers call calculation, if you want to reach the 60% inclusion, financial inclusion, we need more around 10 years to develop the distribution.
Maybe banks should just sell cigarettes too.
Yeah. Maybe they can also use the network used by the cigarette. And then what's the key? I'm talking about the specific condition in Indonesia. We cannot expect directly crowdfunding or online transaction to be happening in Indonesia very soon, because we need the financial inclusion in the first place. That's why in Indonesia, the bank will not become a dinosaur in, let's say, another 10 to 15 years. Then why it's happened, I can tell you a story also. In Indonesia currently, if you don't have my bank account, I can send you the money through your phone number. So I can send you the money through your phone number, even though you don't have the account in the bank. After you do some registration or something, and then you can convert the money that I transfer to you to get the cash. The most any sophisticated phone we have, this one, we can do everything for the bank transaction. We do the online, we do the transfer, but still the handphone has a limitation, right? I don't see any handphone that can accept my money. If I want to put my money in the bank, and then the phone will swallow my money. Right? No phone can do that. You cannot also take the cash from your phone. You cannot. Currently, you cannot do that. So that as long as the cash transaction is still high in a certain country, we still need the bank infrastructure to support that kind of transaction. That's to answer the first, that in Indonesia, the banks will still have a future, let's say in the 10 years or 15 years. But I agree that the bank should also transform, because it is, fintechs also change everything. And then including the way the bank do the transaction. In the last few years, maybe you will fire your employee if you see they are playing the social media in the working hours. If you see they are playing with Facebook, Instagram, pet, or whatever social media you can mention, you will give, a warning letter to the employee. But now, employee can argue that the most effective marketing, even for the bank product, is through social media. So you cannot, give a rules or whatever that makes the employee cannot access their social media. So that's the way the bank transform. And then in the future, let's say if we want to connect it with the crowdfunding, in my vision, the crowdfunding can be the product of the bank also. That's also written in I already mentioned in the first session, the book Bank 3.0, written by Brad King. The bank is not something you go anymore, but it's more something you do, including crowdfunding.
Okay, well, let's hear from one of the platforms here. We have two. We have Mulasense and Beehive. Justin, you're running a growing global platform. You're based in Dubai, correct? You're setting up operations here, UK, Turkey. You're talking global domination here, right? So, what is your vision for the future of banking?
I think banking is here to stay, and there's many reasons for that. But thank you for the global domination comments as well. It's very flattering. We talked earlier this morning, and some other people have mentioned it, but it comes down to partly, I think, in the first instance, almost cause and effect. The regulators do have a tough position. They've certainly had one since the financial crisis. We've gone through a cycle of deleveraging the global economy, trying to control risks at banks, which has pushed up their costs, as you mentioned also, which sometimes make their finance to SMEs basically too expensive to deliver commercially into market. So traditionally, risk capital that's there to service growth, a fair chunk of that's been diverted more to the purchase of government bonds, and we basically end up with a funding gap in the marketplace. In many countries in Asia, the banks are either not able to or willing to, because of regulatory compliance in the first place, to basically issue non-collateralized loans for the SMEs. So this is the cause and effect part of the argument. So does this mean banks don't have a place in the marketplace? Will they disappear off the radar? I probably think far from it. I think, progressive banks are opening up to the possibilities, whether it's Bitcoin, blockchain, peer-to-peer platforms for origination and distribution. But ultimately, it's about coexisting in the marketplace and complementing each other's strengths. As peer-to-peer platforms like Lawrence and myself, or and the peer business side, we're not MFIs, we're not lenders of last resort, but we're looking for healthy, efficient, well-managed small companies issuing small working capital and trade finance type loans, and ultimately these same companies will then become customers of the banks regardless. So from the bank's perspective, they have a choice. Rather than try and fight each other head on, it's about finding those synergies. So we work with the banks. We're creating a customer base for them. If they follow the kind of model that's evolving in the Western markets, they're becoming indirect lenders. They're using their loan strength and balance sheet strength to lend institutional pools of capitals from banks back across platforms. So they can do that without a lot of those costs in between, which is what makes us efficient in the first place. So I think overall, unless I'm mistaken, I can't see the banks just giving up and putting up a close sign anytime soon. So it's just a case of trying to work together, and really for the single benefit, and that benefit is putting the funding where it is. You know, I think many people have mentioned it. We all keep talking about it. International development funds talk about it. You know, SMEs are the engine of the economies. It's wealth creation. It's job creation, and that's where we need to be directing our efforts. So I'm a fan of the banks.
All right, so Eddie, we have a couple entrepreneurial types here that have done a lot of innovation themselves. Is Justin being too diplomatic? Is he really just a Trojan horse here? He's just sneaking in, you know? Is that what's going on here?
I know it's funny. I would say that, you know, the banks actually, I wouldn't say that, you know, they will be disappear, you know. Definitely, you know, some actually will be disrupted. And for those banks, you know, I mean, sort of the quote, CEO of DBS Bank here, I think a few months ago, he mentioned multiple times that, you know, if they're not going to innovate, they probably may not survive. You know. Of course, you know, the message is not just to the public, it's also to all the colleagues. And we look at that, you know, Stan Chart just said, you know, 15,000 workers out of 86,000. And you mentioned that, you know, because of the compliance, the cost, and all that. If I were to sum up, why there's a possibility of disruption, it is because thanks to WorldCom, you know, and Lehman Brothers and all that, right now it is getting extremely costly actually to run a bank, mainly because of the compliance and all that, and also because of that, you know, they are unlikely actually to deal with, for example, SME, because they don't have a track record and all that. For those actually manage to, you know, sort of take this opportunity and make money out of that. You know, one of the big example it is Alibaba Group, like Alipay, Taobao. You know, I mean not Taobao, the Yuba, and they actually they call, you know, shadow banking. You know, during the peak, I think, you know, there's probably one day, every day there's 1 billion renminbi transferred out from the traditional bank to the online bank, I mean to those shadow banking. 1 billion renminbi, that is about 130 million US dollar a day. So that kind of rate. And because they give you a lot more better interest rate. And of course, Alibaba last year, it's now called Ant Financial. They put Alipay and all this under Ant Financial. And that, they also apply for the banking license now. It's called My Bank. They got it last year in October. It's because also Ant Financial invested in one of my startup in Series B. So I met them, I get to know them, you know, why they can manage to do this kind of business and disrupt, you know, or complement. They would say they complement their traditional banking because all the top 10 banks in China, you know, they don't loan to the SME because it is just really risky. Even though they're willing to pay 40–50% interest rate, they don't want to do. They're not even allowed to do that. Okay. And but for Alibaba, because they're multiple platform, you know, in Taobao, Alibaba, Tmall, and all this, they know the buyer and also the merchant and the manufacturers. You know, they know your trading records. They know even in the social media whether they like your product or they don't like your product. So if you tell me that, you know, this company or this manufacturer, you know, want to loan, say, $1 million US, and you look at the trading record, my goodness, there's nothing actually in the platform. Of course, the KYC, know your clients, immediately done, you know, I'm not going to loan to you. So they have a lot of data, actually they can do a lot of big data analytics that, you know, nobody have that kind of capability, to be honest. So that's why the daring to loan to you, I mean, Basically, they take the fund actually from the public, from the crowd, give them high interest, and then loan to you at a very reasonable rate. You're not talking about loan shark. But their banking actually there's no branch. It's a technology bank. Everything is all mobile. Everything.
So the banks are seeking this business.
Okay. It is because the bank, I would say that's why I say complementary. Their positioning is complementary. Of course, you look at what happened in Singapore. Singapore banks, like they do loan to, SME as well. But terms and conditions and all this, you need to have personal guarantee. You need to sign your life away and all this. So that make a lot of SME is like it is nearly impossible to get it, especially startup. That's why the startup or even a slightly more established startup, they never want to sort of get the financing from the bank. So that is the gap. So that's why in the last few years there's the P2P lending, the P2 business lending, start to disrupt the market. But I would say it's really disrupted. It's like nobody even serving this market. So it's a complementary. But if the bank actually it is later on, if they want to get back into this market, probably they have to do something. Actually, is either buy them up or they have to change the business model. Having said that, the risk actually is way too high, and at the moment those like the P2 business or P2 platform actually is not really regulated. So that's why the cost of doing that kind of business, that's how low. It is so low. Wait until the non-performing loans start to rise up. They will face the same music, meaning that the cost actually will go up, and the central bank in all the country will start to regulate.
Okay, well, we're going to get that in a second. Mark, you're another entrepreneurial type. What is your view on the future of banks? Do they survive? What happens to them?
I think there's a place for everyone in all the institutions. At the end of the day, it's about pricing the risk. So, for example, if I put my money with DBS Bank, I expect a very low interest rate because it's safe. If I want to invest in a P2P platform, it can be I can put in my funds with them, but I know the risk is high. So I price it and I expect a high return. So there's a place for everybody. Banks, unfortunately, moving forward, the noose is tightening around because banks are heavily regulated. They have to fulfill compliance rules. They have checks, and because of this, the barrier to entry is also very high. And to keep the startups and the fintechs from kind of intruding into their space, they will actually speak to the regulator and say, I would like to have more regulation. Not by imposing on themselves, but more regulations to be a bank.
That doesn't sound very encouraging. No, it's an answer
for the banks to survive, right? So I think back on Edie's case, telcos, Singtel versus DBS. What is the subscriber base for Singtel in the region? I think it's about 430 million. 501 million. Yeah, it's going up every second. So, can Singtel have DBS lunch? I think the answer is probably not, because those are just nodes, distribution points for money. I can transfer money between social media, Facebook, WhatsApp. I can transfer money to other people, but it's just a means of disseminating and distributing money. But today, in this current state of affairs, only the banks can take in deposits and then be the regulated body. And the bank can easily acquire this form of distribution nodes if they want to. So in short, my answer is yes, they're in trouble. They're stuck between a rock and a hard place, but it's not the end of it yet, because they can buy themselves out of trouble if they want to.
They can't buy themselves out of trouble. But isn't the real question about innovation? I mean, banks traditionally are not very innovative. They don't have a culture where they want to change. They want to keep things the same, and that's how they operate. Lawrence, how many employees do you have today now?
We currently have 12.
So you have 12. So let me guess. How many committees do you have when you need to make a decision?
Just
One. Now, if you went to a bank that has 40,000 employees, how many committees do you think they need to go through to have a decision made to get something changed in the process? My guess is that when you guys want to change things, you move pretty quickly.
Yeah, absolutely. I mean, we won't have product committees to assess, all these procedures. We don't need to get sign-offs from 10, 20 global heads. I mean, I used to be a product manager at the bank, and I used
So
to.
you know how that happens,
Yeah.
don't you?
So it takes 3 to 6 months at least, or 6 months to 9 months cycle to get a paper approved.
That doesn't make sense.
Yeah. But I would just like to expand a little bit on Eddie's point about, about fintechs like us being complementary. See, essentially we're solving a market failure. And let me give you an example. So Eddie mentioned about small companies or startup companies not being able to access bank financing. Now we see that here in Singapore. And the government has intervened with a series of measures, like for instance, the microloan scheme, credit scoring models. And therefore, in applying all these techniques or methodology, integrating big data and stuff like that, we can potentially serve a greater segment, a wider segment of SMEs. And I think, in general, some of my conversations with banks, I think they are looking quite closely in this space. More from a collaborative stand than from a competing stand, because players like us, we are serving a segment that they are not naturally serving. And in the world of banking, customer acquisition is very valuable. If one day we can, funnel this group of customers, make them ready to be bank-ready customers, this would be something that would be a valuable proposition for banks.
So you see partnering, that you want to partner with the banks. You want to be their innovation arm.
Yeah, I think it's vice versa. No comment on that.
So thinking back to you, you're working with a bank, you're also running a peer-to-peer platform. Isn't it just a challenge to get things done in a big institution like a traditional bank? Is innovation something that's kind of like anathema to the culture? That it's a culture that fights change.
Yeah. The real example is when I developed the platform itself. If it is become the product of the bank, I'm very sure it will be 10 times longer and 10 times more expensive. I do it with only 5 people I do as the initiator for peer-to-peer lending also, because my job in the bank as a commissioner is non-executive and it's not full-time, so I still have time to do that. But that's to give you an agreement that in the traditional bank, when you do the innovation, when you're creating new products, sometimes it took longer and more expensive. We have to admit that, because the bigger the organization, the more bureaucracy on the banks, it will for sure not make a flexibility for the bank to innovate.
Yeah, I mean, because you're publicly traded, the bank is publicly traded, you're driven by quarterly results. If you fail at something, it's a big issue. These two guys, something goes wrong, they're like, we'll do something else. Nobody cares. They just keep innovating, they just keep being more creative, changing, iterating. They're just evolving very quickly. They're just more nimble, more ready to adapt and create than a traditional bank. And I think over the long run, that's where you start seeing things getting undermined in a traditional financial institution like a bank. Mark, what do you think?
Yeah, I think by design, banks have to go slow. I mean, that's why I keep my money with the banks. Which is interesting, because if you think about it, back in your bank, any innovation you probably have to pitch it to the board of directors. So out of the 10 directors, if one of them say no, the project is canned. Right? For them, they meet 10 angels, 10 VCs. They just need one VC to say yes, and they go live. So this is why there's one of EE and two we have already on the stage already, more in text around the neighborhood and then nibbling away at the tail of the big banks.
I want to make one point, right? You say, the bank actually, or telco, they may sort of like, worry about, whether, because it may affect the result and all that. Let me give you an example. Like Singtel, they put up the $250 million actually is off the P&L. Actually, going to invest, it won't affect it. In fact, during lunchtime, I was in a bank, they just launched an innovation lab. Okay, it is a joint venture as well, so it's off their P&L. Okay, so it will not affect. They know all this now. They also start to realize that they are not going to let those because they believe that it will fail. Most of them, and probably 10% probably will survive and become big, and they will have an early involvement, adoption of this kind of technology, and then they will bring it mainstream. But it will not affect, affect the P&L. So I just want to answer that now. A lot of big banks and telcos actually they set up a fund just to do that.
So that's how they manage the risk of innovation in creating a culture of failure. Because really you can't have an entrepreneurial base or an innovation economy unless you embrace the culture of failure. And that is wholly opposed to banks, right?
So they just jump in a quick comment. I think with this model of segregating funds for future innovation, I think this is like an arm's length model of innovation. But in order for a bank to, at this point in time, to truly integrate new technologies, I think there's still going to be some challenge. And the challenge may not be P&L, but it's reputational. Because banks, as it is, they are all billion-dollar entities. They've got a huge brand, a huge franchise to protect, guard against. The whole value of the banking business is about trust. So before they can fully implement or adopt a new technology, they've got to make sure that it doesn't affect or erode any of that trust, right, in the eyes of the public and in the eyes of the regulator as well.
I want to talk about cost here for a second. Justin,
Just going to follow on from Morris's comments because there's also an argument for and against peer-to-peer based on what you're saying there. So on the one hand, clearly there are some markets in Asia where there are grey areas and people operate without necessarily a structured framework, something you can imagine that the banks will be keen to introduce. But there's also an argument about best practice and setting the standards, because for genuine operators, we would welcome the regulation because we have our KYCs, our AMLs, we have our client protections, we have all of the traditional mechanisms to create the trust that you would expect of a bank, and certainly for the benefit of the regulators to bring that in and help us, but also from the perspective of looking at an industry. We keep talking about an ecosystem, and somebody's mentioned today about an issue of fraud on equity crowdfunding. Ultimately, the longer that it takes for regulation to come in, the likelier it is that we are going to see, a $10,000 or $20,000 website that doesn't have these checks and balances, and that's where the risk is run. Because ultimately, we need to be protecting the industry, educating the people who are trying to create and deliver and solve a funding issue in markets that's a fundamental issue, but we need to do it in the right way. So, it's part and parcel of this growth we're going through over the next year or so.
It's interesting. I think most peer-to-peer marketplace owners, they've embraced regulation as long as it's thoughtful and light touch and makes sense. I think a lot of the regulation should be self-regulation. Is that the industry should set the best practices. That's the most effective way. And I want to come back again to cost, because there's really a cost equation here that the two of you can just beat the daylights out of banks. I mean, you have 12 employees. How many employees do you have at Beehive?
About 30 globally.
Okay, and for your bank, how many employees do you have? Okay, thousands. All right, you got a lot. So you guys are making loans. Your cost structure is hugely different. You can lend at a lower rate to the borrower, and you can return a higher rate to the investor. How does a bank compete with them?
Have a quick input on that. I mean, ultimately, we as platforms are not actually doing any lending, of course. It's the participants on the platform, effectively, that are doing the lending. You talk about, and this is comparing apples to pears, unfortunately, because banks operate under a reserve banking, fractional banking model, and have great access to cheap liquidity through central governments and central markets. And effectively can leverage that up in a peer-to-peer universe. There's no systemic risk, it's one-to-one, dollar for dollar. So again, they're not the same in that sense, and again, the negatives that we perceive in banking, I think more to do with the conversation we had just now in terms of speed to market. If we're talking about, agility in terms of product innovation, we're talking about agility across this peer-to-peer universe, but we're not really putting that in the perspective of a small and medium enterprise. When you're a company with a $500,000 turnover, and you have an opportunity to win a contract and you have to put up a performance bond, the difference between being able to get that performance bond, your pre-purchase working capital in 10 days instead of 10 months, is the difference between expanding and slowing down. So, in terms of the bank argument and loan books, they really are quite different models, and this comes back to being complementary. We have speed to market, and the technology brings efficiency. The technology is solving it.
So, Mark, Lending Club has based their entire model off the fact that they can lend for less and they can pay more. And they've started with consumer loans because this is low-hanging fruit. It's easy. It's credit card consolidation. It's just small consumer loans. And they've built this into a multi-billion-dollar business. Now, after they fine-tune that model, they want to get into SME finance. So this is kind of, first step, second step, but you can see how that's ratcheting up. How does that evolve going forward? I mean, it really comes down to, cost competition. Now, they partner with banks too, and they say nice things about banks, but you can tell that, they really want to eat the banks for breakfast.
It'll be quite controversial here. I think fintechs will always remain as fintechs. Your question as to where will they stop, I think they'll stop right before they become a bank, because they'll never be a bank. It's regulated, right? If you want to call yourself a bank, you need to fulfill the compliance. And there's no reason why they should become a bank, because they lose their competitive advantage. So there's a role, it's really the interesting point you brought about credit cards. I think when credit cards was first introduced, maybe the question people asked was, is this the end of the banks? But the banks can also issue credit cards. They can take on franchise, they can work with other forms of asset allocation. So I think in short, is fintechs will stay as fintechs with different business models, and they will stop short of becoming a bank, because once they become a bank, they lose the competitive advantage.
So what about platforms that want to do everything a bank does, but they don't want to have insured deposits?
Yeah, if they could achieve that, I think it's all the better. And in fact, a lot of startups come to us and pitch for money, a lot of crowdfunding sites. I know they're regulators in this room, but my question to them is, why would you want to be regulated? Try to not be regulated. You can actually go around and figure a way out to do business without having to take on certain roles to be called an insurance company or a bank, and you have a competitive advantage.
So Mike Cagney of SoFi just received I think $1 billion capital capital injection from SoftBank, which is a lot of money. And it gave him some flexibility. Originally, last year, he was talking about doing an IPO this year. Now he's pretty much said that he doesn't feel the need to do an IPO because he has sufficient capital to do whatever he wants. He thinks that his competitors, whether the Prosper or all the other direct lending platforms, they lack initiative. And what he wants to do is he wants to basically become a bank without becoming a regulated entity. And that's his vision for the future. Do you see that as a possibility happening here in Southeast Asia? What about China? We're already talking about what Alibaba's doing and a lot of the other internet platforms. Start with you. So we're talking about becoming a regulated entity.
Yeah.
I understand people don't want to be regulated because there's a cost, there's a compliance cost again. So platforms don't want to go down that path. But you're seeing some platforms that say, well, we can work around that. We can provide all the same services without becoming a regulated entity. And you're starting to see that in the US. I think Alibaba has done some of that. And since you've worked with Alibaba, what's your viewpoint on that?
Well, I think, I tend to agree with what Mark said. I mean, when certain things, last year was in London, I met up with the central bank as well, and they look at the crowdfunding. Basically, they want to deregulate. Actually, they have some guideline on the 1st of April last year, and then they say they want it to continue to innovate, but they don't want to regulate them, right? Because the size compared to the whole entire financial market is like 0.001%, it's nothing, okay? But they don't want to kill them. In China, I was very surprised, actually, this last year, they allowed, not last year, in the last few years, they allowed shadow banking. I thought they will regulate, but they didn't regulate. They didn't regulate. It is because they see that there is something that, the market is not well served. It is underserved. But based on the existing banking regimes and all that, there's a lot of manufacturing. And that is the backbone of the whole entire China economy. So you cannot force the bank to go and loan them because you need to have about, your ratio, all your compliance you have to meet, right? So that's why they allow that to happen, to serve. So different countries have different consideration. Singapore, obviously, is like, don't do it right now. Because we all know that, right? So that's why we still have no sort of official platform, actually. So everybody is trying to bypass and, trying not to be regulated. I would say that when these things actually is getting bigger and bigger and bigger, and you are really getting close to become a bank, you will be regulated. Because, at the end of the day, the government, the central bank, is to protect the citizens' interests. If you are not regulated, you're talking about, probably a life-saving and all that. I mean, not everybody understand what it means by crowdfunding, the raise and all this. Probably it is like, this auntie and uncle, the life-saving $20,000, $30,000. I mean, that is what the government is really worried. I mean, it's another Lehman Brothers. People couldn't protest in front of the government house, return all my money and all this. That is the last thing we really want to see. So at the moment, it is small. So that's why they let you do something. When they get bigger and bigger, and I hope it won't happen, it is like when this disaster happens. That means when there's an economic crisis, when the non-performing loan is really go up to 40%, 50%, At the moment, everybody is very happy because, you pay me interest, I'm going to return to you after 6 months and all that. Very happy. Only when there's some problems start to come up, then the issue will become magnified. Okay, so again, I would say that is still evolving. Okay, and a lot of fintech companies trying not to be regulated. For that for sure.
Well, there's always been a credit. Zopa's gone through a credit cycle. Lending Club's gone through a credit cycle. They both went through the crisis, and and they actually perform quite well. So I agree with you, there's still a lot of questions out there because they're probably the seniors in the group. Some of these newer platforms are coming online, and you're not quite certain what you go through the entire credit cycle. But so far, it's been promising. You learn that too.
Yeah, not just that, also that, in the regulation of the financial sector, I think there are a number of different entities. Bank is one entity, a broker-dealer is another entity. So there are various degrees of regulation. So what is the business of banking? If you understand, the core definition of banking, that is collecting deposit and lending it out. Are platforms like us in the business of banking? Most definitely not. Platforms like us, we facilitate lending, we do the matching. It's a matching business. So the next question begs, so are we a broker-dealer? And in fact, this is a question that we have spent quite a bit of time in our engagement with the regulator. Does what we are doing now today constitute security offering? Now, if it does, then most definitely you need to be regulated under a capital markets license, right? As an operator in the capital markets. So we have found a shelter where we are, offering the P2P loans on our platform, not as a security, but as a promissory note. And that avoids securities regulation. That avoids us encountering securities regulation. Now, is regulation necessary for this sector, to nurture this crowdfunding or this P2P lending sector? In my opinion, I think it is necessary. And I think it is important, and even it is beneficial to further the growth of this industry. But the regulations need to be balanced and appropriate. It needs to regulate where it needs to regulate. For instance, if you're not a bank, we're not a bank. If you're not doing the business of underwriting securities, then we shouldn't be asked to comply to the business of securities regulation. So I think there needs to be a separate category of regulation that will allow such platforms to operate with certain requirements, but not with the onerous requirements of compliance for the existing traditional FIs.
So you want regulations, but you don't want to have to go through the compliance costs that banks do.
Yeah,
Different regulations.
because we're not a bank, because we're not doing the business exactly.
But you're providing similar services, and I think that is very much part of the question here is you're taking away business that used to be done by a bank. When you have banks that can't give loans, SME loans, prime and super prime customers, something's wrong with that bank. Something is broken at that bank because they're saying, we can't do this because it's not cost effective. But you're creating some pretty profound opportunity for two guys like this who can say, I can make a killing. Isn't that right, Justin?
I don't think it's about making a killing, it's about
Well, I do.
a one-size-fits-all, credit policy for a large bank, in many ways makes sense because of the dynamics of the bank as we've mentioned before. So whether you're putting in third-party credit reports, ticking boxes, going through a standardized process, I can understand the logic for it. Outside of some of the other, functional issues we've mentioned in terms of the SMEs accessing that capital, whereas, again, this comes back to the fintech, the tech part of that is, we've mentioned big data. It's about not having one size fits all. A bank can sit down in front of every single one of its SME loan customers and sit there and understand, their history, how long they've been in the industry, and to really go quantitative and qualitative, is a time and cost, process for them as well. Whereas I remember with technology and data analytics, there are other ways to assess the credit picture of a borrower that comes to the bank. But in terms of going back to this regulatory piece, we do want it.